Today we're going to break down this really powerful framework that businesses use to figure out if they should pour millions or even billions of dollars into a new project. We're using a fantastic guide by Adriano Pinto Mariano to walk through something called a techno-economic analysis. Let's jump right in.
You know, every single person with a big idea faces this exact question. You've got this amazing concept, something you think could be a total game changer. But before you go all in, you have to ask, is this thing actually going to make money? How do you know for sure if you're about to strike gold or just dig yourself a massive hole?
To get our heads around the logic, let's start with a super simple analogy. Imagine you're opening a restaurant. You've got three choices. The Japanese place, that's going to cost $1 million to set up, and it'll clear about 100 grand in profit each year. The Italian spot makes about 80 grand. But then, look at the Brazilian restaurant. It brings in 500,000 in revenue, costs 250, which means it clears a massive $250,000 in profit every single year. So, which one do you think pays for itself the fastest?
Yep, the Brazilian place. It's simple math, right? You take that initial investment, the $900,000, and you divide it by the annual profit, $250,000, and you get 3.6 years. This is what we call payback time. It's the most basic gut-level indicator of a good investment. It just answers one simple question: how long till I get my money back?
And here is the absolute key. That simple little calculation we just did for a restaurant, it is the exact same fundamental logic that's used to evaluate a massive billion-dollar factory. The numbers are way bigger, but the principle, it's exactly the same.
So, let's level up from our restaurant example and look at the actual professional framework. How do we take that basic idea and turn it into what we could call a final scorecard for a huge project? Well, it's a really structured 5-step process. This is the roadmap the pros use. First up, you got a process diagram, just to see how all the pieces of the puzzle fit together. Step 2 gets technical, mass and energy balances. You're figuring out exactly what goes in and what comes out. Once you know that, you can move to Step 3, estimating all your costs and revenues. From there, you map those numbers out over time in a cash flow analysis, which finally lets you calculate the big one. Step 5, the economic indicators that give you the final verdict. Okay, so to get to that verdict, we have to get a handle on a project's costs. And really, there are two fundamental types. Think of them as two sides of the same coin: CAPEX and OPEX.
It's actually really straightforward. CAPEX, that's your capital expenditure. It's the huge one-time cost to actually build the thing. Buying the land, all the big machinery, and getting it installed. Then you have OPEX, operating expenditure. That's everything else, all the recurring, day-to-day costs to just keep the lights on. We're talking raw materials, electricity bills, paying your employees, and regular maintenance.
And this is so important, because here's the trap a lot of people fall into. It's easy to think CAPEX is just the sticker price on a new piece of gear. But as engineering consultant Mark Warner points out, the cost to install it, all the concrete, the piping, the wiring, that can actually be more expensive than the machine itself. That's a detail you absolutely cannot forget.
Okay, so we're starting to understand the costs, but to get a really accurate picture, we have to add another ingredient to the mix: the value of time. This is where the analysis gets, well, a lot smarter and a lot more powerful than just simple payback time.
This idea is basically the foundation of all modern finance. It's simple. $1 in your hand right now is worth more than the promise of $1 a year from now. Why? Because you could take that dollar today, put it in the bank, and it would start earning interest immediately. It's a simple concept, but it's what lets us compare money across different points in time, which is crucial.
So that brings us to our first magic metric: net present value, or NPV. What it does is it takes all the money a project is going to make in the future, and it uses that time value of money idea to figure out what all that future cash is worth today. Then, it subtracts your initial investment. It basically answers the biggest question of all. In today's money, how much wealth is this project actually going to create?
And the decision rule? It couldn't be simpler. If the net present value is greater than 0, it means the project is set to create more value than it costs. It's a thumbs up. It's economically viable. If it's less than 0, it's a financial black hole. It's a really clear, powerful line in the sand. All right, our second key metric is the internal rate of return, or IRR. Now, if NPV tells you how much value you're creating in dollars, IRR tells you how fast your investment is growing as a percentage. You can think of it like the project's own internal interest rate. And this is so useful because it lets you compare your project's performance against anything else: the stock market, a savings account, you name it. So the rule for IRR is also pretty simple. It has to clear a hurdle. Every company has what's called a minimum attractive rate of return, basically a target they need to beat. If your project's IRR is higher than that target, you've got a green light, it's a go. If it's not, well, that money could probably work harder for you somewhere else.
So far, all of our numbers have been these nice, neat estimates. But we all know that the real world is messy, and things almost never go exactly according to plan. So that brings us to the last and maybe the most critical step, figuring out the project's real-world risk.
These are exactly the kinds of what-if questions that keep project managers awake at night. What if the cost of our raw materials doubles? What if the market price for our product suddenly crashes? What if our fancy new technology is only 80% as good as the engineers promised? A solid analysis has to wrestle with these questions. So the first tool we pull out is called a sensitivity analysis, and it's basically a stress test for our financial model. We go in and we change one key variable at a time. We crank up the operating costs, we dial down the product price, and we watch what happens to the profit. This tells us really quickly which factors have the most power to sink our project.
And the results often look something like this. This chart immediately flags the project's biggest weak spots. You can see right away that a change in the product selling price has a massive impact on the bottom line, way more than a similar change in operating costs. This tells you exactly what you need to worry about the most.
But see, that analysis only changes one thing at a time. What happens in the real world when everything is changing all at once? Well, for that, we need a more powerful tool, the Monte Carlo analysis. Here, instead of plugging in one number, we give the model a whole range of possible outcomes for each variable. Then, we tell the computer to run the simulation thousands of times, creating thousands of different possible futures for our project. And the final result is, wow, it's incredibly powerful. After simulating all those possible futures, the analysis spits out a single, beautiful number, the probability of success. In this case study, there's a 40% chance the project will end up with a positive net present value. It doesn't just tell you if the project can succeed, it tells you the actual odds that it will.
All right, let's bring this all home. We've gone all the way from a simple restaurant idea to a full-blown professional framework that can evaluate pretty much any major project out there. This is how you create that final scorecard for your own big ideas.
So here it is, your takeaway toolkit. You start simple. What's the payback time? Then you dig in and count the costs, CAPEX and OPEX. Next, you elevate your game by looking at NPV and IRR to factor in the time value of money. After that, you've got to stress test everything with a sensitivity analysis to find your weak spots. And finally, you run the numbers to find out the actual probability of success.
We've just walked through the entire framework that turns a gut feeling into a hard, data-driven decision. It's a journey from a simple idea to a really sophisticated understanding of value, risk, and probability. So, I guess the only question left to ask is, now that you have the tools, is your big idea ready for its final scorecard?